Hi all, and welcome to this video. We have just concluded the first half of 2022, and the volatility that we have seen in the last 6 months has been unbelievable for most of us. Violent moves in either direction without follow-through have caused most traders to quit this market or incur losses. Even the most savvy investors are struggling to cope with the swings in the market. Even the strongest blue chip stocks, including that of Apple, Google, Amazon, Tesla, and Meta, have seen huge double-digit declines this year. Undoubtedly, this has been a difficult year for all, but the volatility is here to stay. Nobody can accurately predict where the market is heading for 2022, but if given a chance, I would still like to position myself for a bullish run going into the second half of the year. The markets have almost priced in for the worst case inflation scenario, and even if we get a slight hint of a dovish Fed in subsequent meetings, we are certain to head to the 4,200 levels based on the Fibonacci levels of 50%. However, don't let my long-term bias shroud the market in the intraday 0 DTE. There are 3 overlapping trends in today's macro environment. The most brutal and rigorous is the stock market, which is the absolute leading indicator primarily due to its liquid nature. We also have the bond market, which tends to portray certain imbalances in the market, the most recent of which was the inverted yield curve, which has predicted a downturn in the economy most accurately. The last is the real estate market, which reacts much slower to changes in the economy and in a more predictable fashion. I hope this gives you an idea of why the stock market has given us an advantage over the other markets. Now, the idea and crux of this video is how do we trade this violent stock market? Almost everyone, including retail investors, hedge funds, and institutions are on the sidelines until we can get a clear signal either on the inflation front or on the GDP numbers. I have always suggested that selling option premiums is the only way to trade any market, being it trending bullish or bearish or consolidation. Any strategy we use should be backed with solid strategic mathematical advantage and differentiated from a discretionary system. We never try to predict where the market will be headed in the near term since frankly, nobody knows. In fact, all our trades are expiring the same day and that helps to keep the guessing to a minimum. Given that the VIX has been hovering around 25 for most of the year, we have been able to take advantage of the excess implied volatility and the overestimation of the expected volatility versus the realized volatility and pocketing the differential profits. We need to recognize the edge that we have when we trade such a SPX 0 DTE system with proper discipline and consistency. Firstly, the biggest edge is time decay, and as you can see, time decay is highest on the day of expiry, hence dramatically increasing our higher chance of profiting with 0 DTE. If the market consolidates or just languishes near a price point for a small amount of time, we immediately get into the profit zone. Second, our next edge is with adjustments. We can constantly adjust the position, trying to minimize delta exposure and certainly adjusting our profit zone. The final edge is with IV, overstating the actual move. This has been a common occurrence in the recent past where the actual move has been less than half of the implied move yielding big profits. Lastly, our emphasis on technical levels of supply-demand and overlap with Fibonacci levels. I have been trading 0 DTE since 2018, where we moved from weekly expiry to 3-day expiry on Monday, Wednesday, Friday. I have great confidence in the system to make consistent returns and in fact is the only tested system to outperform the markets. Additionally, this is suited for all markets due to the versatile nature of SPX. Any questions on option selling, adjustments, please leave a comment or email below. Cheers and have a great day.